Hey, everybody.
Hey.
We're back. It looks like we are live. Dale and Wendy here. It's Wednesday night, and we wanted to talk to you guys today about interest rates because I think we're all kind of over the whole interest rate journey. Our buyers, we're finding they're not too happy how it suddenly kind of changed their perspective from what they thought it was going to be to all of a sudden, oh, wait, I'm not qualified for that after all. Anyway, so we wanted to talk to you guys about that today. Article, what I entitled it is Dallas market sales are going down. Just for fun, I thought I would put on here an article that tells the exact opposite. Just for fun. Okay, so because we always are researching and we want to make sure our data's right, Dale found the first article, I found the second one, and then we were like, wait a minute, who's right? Who's right? Okay, so let me show you the first article. All right. This is what it says. Let me see here now. Let me see if I can go back to the beginning. Okay. This is from Narada Real Estate Investments. And you can see it was written on April 3rd. Okay, so this is not an old article.
So they should have March numbers, you would think.
Go and give it away. I mean, gosh, like spoiler alert. Hope you guys didn't hear that. He didn't like the spoiler alert. Okay. All right. So this was April. Okay. The Texas housing market, much like this is very, very poetic, much like a phoenix rising from the ashes, rebounded from the previous month's downturn, displaying resilience in the face of challenges. Despite mortgage rates lingering at elevated levels, the market witnessed a remarkable surge in home sales, showcasing an upward trajectory.
A bit dramatic.
Yeah, a bit dramatic. Yeah. Okay, note the red arrow. According to recent data, Texas experienced a 14.6% increase in total home sales month over month, with a staggering 29,209 homes sold. This surge in sales is particularly noteworthy as it spans across all major cities in Texas, marking a significant improvement compared to the fourth quarter of 2023. So you're probably hearing us read that article going, Wendy, you got the title wrong, because that just said that sales are up. But I did that for a reason, okay, because I wanted to show you it can be confusing, okay, and sometimes you're fed a narrative that isn't necessarily accurate. And take note when you're hearing articles like that, take note of the adjectives, staggering, rising out of the phoenix, right? Because it's all meant to point you in a certain direction. It's not really objective, but it could be subtle. Okay, so now let me show you this next article, okay? Let's see here now. Okay. North Texas home sales fell 7% in March. Okay. So different story entirely. North Texas home sales fell by 7% in March, while prices were slightly up from 2023 levels. The year-over-year drop comes after an almost 9% decline in area home purchases during all of 2023. Things seemed to bounce back in January as sales jumped 12.5%, but February saw a small drop of 1.1%. So did you catch that? Okay. The other article was written in March. It was quoting like January, February numbers. Okay. Even though the March data was out, it was referring back to what happened during January and February. Okay. So kind of feeding you a narrative that isn't necessarily accurate right now. And usually, the interesting thing is, usually January and February are slow months, but we're going to talk in a minute about how interest rates have kind of affected that. Okay, let's keep reading. Let's see here now. All right. The median price of homes in Dallas-Fort Worth Metroplex was $395,000 in March, up 1.3% from March of 2023. So I think that's noteworthy as well. The fact that prices have kind of edged up a little bit.
Right.
You know, that we're
From
still
last
seeing
year,
that.
yeah.
Yeah, from year over year, still up a little bit.
Which is typical in this area.
Yeah. Housing affordability continues to be a challenging factor for the existing home market, you think? Said Ted Wilson, principal at Dallas-based Residential Strategies. With the 30-year mortgage rate edging higher toward 7%, actually now it's over 7%, and apparent weakening of employment growth, existing home sales have slowed. Again, you think, okay, but that's not the story the other, list article was telling us. Sales drop. Oh, I think this is huge. Okay. Sales dropped the most in Rockwall County, which saw a 25.5% decline.
Wow.
Only 208 transactions were closed in the county in March. Now, I thought that was pretty amazing because Rockwall County, I mean, they have outstanding schools. The whole county scored an A with the TEA, and they've got the Rockwall ISD, which is very nice. So I thought that was pretty remarkable. And the other thing is, man, that tells you, I mean, isn't Royce City in Rockwall County? I'm thinking it is,
Yeah.
right? So you've got this massive amount of new construction from Royce City. I mean, Royce City has just got tons and tons, okay? And what did the article say? Like how many actually closed? Okay, only 208. Okay, so you got to know that every builder, okay, in Royce City right now and Fate, man, they've got to be motivated. Okay, that is just a crazy 25%. And now keep in mind, when it talks about the 25%, it's not talking about price drops. Okay, it's talking about volume. Okay.
Right.
But you got to know, with as many builders as you have, especially in places like Royce City, that's got to be painful, to have this sales volume. So opportunity knocking over in Rockwall County, the article.
So maybe lots of inventory to choose from out there.
That's what I'm thinking. And Rockwall's a beautiful place. A lot of new construction. I know that we negotiated a great deal on a grand home in Rockwall. They've got a couple of really neat subdivisions there. One that's very boutique-y and small with extra large lots, and then another one that I think has a little bit more in the way of amenities. So, if you're like work from home or flexible, location-wise, don't have a major commute, you might want to think about Rockwall County. Okay, so depending on your price point, excellent deals in Royce City. Fate's a little bit more expensive, a little bit closer, and then you have Rockwall. To the south of that, you have Heath,
right,
which is an adorable area, all custom homes, huge hills and lots of mature trees. And then you've got McClendon Chisholm also, where you tend to get acreage. So some real opportunities there. And look at that, how that volume is down. All right, so why? That's the big question. Why are the sales down? Okay, so let's take a look at this. All right. Mortgage rates top 7%, triggering a sense of helplessness for many would-be homebuyers. It's probably true because, the public went and fed them a narrative.
Yeah.
In December and January, saying that rates were going to be dropped by March, right? Now we're pushing May, halfway through April, and rates are going up instead. So just not at all what was predicted. Okay, it's official. Mortgage rates are back up above 7%. Even worse, rates could rise further after U.S. Federal Reserve Chair Jerome Powell said policymakers were in no rush to cut rates while inflation remains stronger than anticipated. Mortgage rates averaged 7.1% in the week ending April 18, according to Freddie Mac. That was up from 6.88% in the previous week. So that's a big jump, okay, in 1 week. And it's the first time rates have been above 7% since early December. These higher rates are frustrating home buyers and sellers, thwarting many of their plans. I get that. It really triggers a sense of helplessness. A lot of people feel stuck and trapped against their will into certain living situations. So if you want to know how, relocators and buyers and sellers feel in Dallas right now, It's not pretty. It's not fun. Every additional point increase is a little more financially and psychologically painful for buyers. Okay. A 6% means something very different than a 7%. Okay. It bears more weight. Even if it's 6.9% versus 7%, it means something different. So there's kind of a psychological element here. When mortgage broker Rock Andrews began seeing rates top 7% last Friday, he immediately became concerned about the impact on potential borrowers. When rates go up, people hunker down and don't spend, says Andrews of Lending Arizona. They've been told for so long that rates are coming down, so they just postpone. And isn't that the truth? That was the narrative that we were fed, back in December. Everybody was so excited. Others might no longer qualify at all. Also very true for loans, or will be able to qualify only for smaller loans. So makes a difference.
Right. Because it
100%.
means that their debt to income ratio is going to be higher.
Mm-hmm.
So because the rates are making their monthly payments higher. So. And they're not getting rid of their debt.
Yeah. If inflation remains high, mortgage rates, listen to this. If inflation remains high, this hurts. Just reading it, rates could climb to 8%, says Realtor.com chief economist Danielle Hale. 8%. Wow. As mortgage rates typically follow the same trajectory as the Fed's rates, they're expected to remain elevated until inflation falls and the Fed announces rate cuts. Okay, so there's a lot there. Buyers are frustrated, and understandably so.
True.
We wanted rates, expected rates. Okay. I have to say that when the narrative was being fed like in December and January, I wasn't really sure I believed it.
Which narrative?
The narrative that rates were going to come down.
Oh, yeah. Well, they've been saying, talked about that all last year.
Mm-hmm.
Some very smart economists, very smart pundits and stuff, that just know this stuff, but they just, the Fed's pretty stubborn.
Yeah.
So and I think also though, there's some of this has to do with these supposed good employment numbers. So,
yes. In fact, I recently saw an email that said that Tesla just laid off 1,200 workers in Austin.
Yeah.
And that's a lot.
Yeah.
That's a lot for Austin to take a hit. So I thought that was really interesting. All right, let's check out another article because I want to show you this. Okay. March, just another one that helps you see March home sales dropped despite a surge in supply. And so that is very true. We definitely saw a surge in supply.
Right.
And keep in mind, we've got vying factors here, demand and supply with, and now we've got way more supply and demand isn't matching it. We've got March sales dropping. Sales of previously owned homes dropped 4.3% in March. Now, keep in mind, this is on a national level.
Right.
Okay. So we saw 7% in Dallas, which tells you Dallas was actually worse than what, happened nationally. Compared with February to a seasonally adjusted annualized rate of 4.19 million units, according to the NAR, sales were 3.7% lower than in March of 2023. So this came after a big jump in sales in February. So again, kind of referring back to that first article that was kind of misleading, was they jumped to February and didn't even tell you about March. So got to be up to date on those trends. You got to dig a little bit too. And I will say something about that article. I clicked on the links where it was referencing its data, and one of them was a dead link. It didn't go anywhere. And then one led to like a general website, but it didn't lead to the statistics. So I found that interesting. I was like, okay, this article is using old data and it's not actually linking to what it says it's linking. So anyway, I found that interesting. Okay, let's see here now. Rising mortgage rates are likely the cause of the slowdown.
I wonder.
Wow. Could that be a more profound statement? I don't know. This sales count is based on closings from contracts likely signed in January and February. Mortgage rates stayed lower in January in the mid 6% range on the popular 30-year fixed loan. They then shot higher in February. And I think that right there is your explanation Dallas is just really rate sensitive. And so, in January, well, and also know this, when you're hearing about like February, what happened in February, we're talking about homes that went under contract in January.
Right.
And the same with March. So you're talking about homes that went under contract in February and kind of follows that way. And so you had, an unusually strong January, which is weird.
Yeah.
I mean, Dallas is usually really, really slow, but interest rates were lower, and
people were probably tired of waiting too.
Yeah. They saw 6% and they jumped in. Now I will say this. I have heard various people say, oh, look out, because, when rates go down, it's going to turn into 2021 all over again. I don't really agree with that because we have so much more inventory. Okay.
As long as they don't go down too much.
Yeah. Like we don't want them to go down a lot, but if they were to go down, I think all the people that I think there's kind of a pressure component. Like, like you need to buy right now while rates are high, because when rates go down, it's going to be a slaughter fest. We're going to be back to 30 offers on one house. I would say don't buy into that.
Yeah.
But as always, what does the data say? It shows that you will see an uptick, because January is usually a slow month, but we definitely saw an uptick when we dropped we were down like almost a point.
Mm-hmm.
And we did see an uptick. Okay. So you will see an uptick, but not a slaughter fest. So if anybody's pressuring you in that regard, and you guys know I'm very anti-pressure. I don't like any time a buyer gets pressured. But if they are, just know that it's not going to turn into a crazy wild fest. Okay. But let me show you kind of what I'm talking about here. Okay. So this was our high point. October was both ugly and beautiful, depending on how you talk about it. We had some really great negotiations in October. And this is why, man, rates were almost 8%, 7.79 in October. And it was a lot of fun. I love I love negotiating. A lot of times it's him doing the negotiating, but it's still really fun to listen to. Still, we both negotiate, but he's really good at it. But negotiating is a big deal. And when rates are like that, man, that is a golden opportunity. We negotiated like 75,000 off of one, 100,000 off of another. On the lower price end, I think we were getting like 30,000 off. And these were on pre-owned, so it wasn't like the shuffle of the new construction.
Right.
So we got some excellent deals. Anyway, so that's October. And then you can see what we're talking about by January. Okay, rates are down to 6.6. Okay, so that's why we saw a stronger than usual January, right? You just see more buyers jumping in. That's 6.6. And then, in February, it wasn't like overnight, but they really started going back up again. I think it corresponds with like CPI data being released and stuff.
Yeah.
And that brings us to where we are right now, which is 7.1. Guys, that's just painful. It's just a painful rate of just knowing that that's the interest rate that if you just go in pre-owned home, fixed rate mortgage, don't have anything special going on, that's the going rate. Yeah. 7.1%. So there's just a very crazy market. Now let me show you this. Okay. So this explains it. If we're like, what the heck is Jay Powell doing? Right? Everybody's got something against him. Okay. Why is he not coming down on this? Right? Because everybody's frustrated with this market. Well, it says the Fed is determined not to reduce interest rates too soon. Experts say a mistake the central bank has made in the past. Okay. Yes. And I made a whole video about this, about the big mistake they made back in the 70s and 80s. The Federal Reserve, let's see if I can't quite see this. Oh, well, the Federal Reserve is in no rush to lower its benchmark rate. Earlier expectations that the central bank was planning multiple cuts before the end of the year seem less likely. And I was saying, there was a ton of speculation about it back in January. I mean, people were talking about 4 rate cuts, 6 rate cuts. Yeah. It was just going on and on. On the heels of Friday's strong jobs report, Wednesday's consumer price index increased at a faster than expected pace in March. Both suggest that inflation is staying stubbornly higher, which experts say is likely keeping the Fed on the sidelines. I don't know. I kind of think that parts of that are debatable. I really do. The employment.
Right. Yeah.
I mean, I don't know.
Because every time the employment numbers come out a week or so later, they they have an adjustment.
Yes.
Oh, this is what they really said, but they don't tell anybody.
Right. And
I
so,
mean, yeah,
but it's like
you
a
can see 'em come out.
downplayed when the adjustment, and the adjustment is always in the standpoint of saying more jobs were lost. And yet it's not like, it's kind of like, it's put out there, but yeah. And like I said, I mean, I just recently read an article saying Tesla was laying off 1,200 people in Austin. So that's a big amount. That's a lot for one city. And that's like only in Austin. Like I read the article, and Tesla's doing layoffs everywhere, like thousands of them. So I think, I don't know, the employment part of it, I don't know if I agree with that. Let's see. Okay. Let's see. Now markets are pricing in a less than 20% chance of a rate cut in June. Okay. So we thought rates were going down in March. We were all kind of excited, waiting to jump into the market. And now probably not even June. Okay. The risks of allowing inflation to persist still far outweighs the risk of triggering a recession. That's from Mark Higgins, Senior Vice President at Index Fund Advisors. The Fed's failure. Okay, and here's where it's true. Okay, they're not lying here. The Fed's failure to do this in the late 1960s is one of the major factors that allowed inflation to become entrenched in the 1970s. And if you haven't studied up on that, it is really is fascinating. I did a whole video on it, and it released, I think, in December. And I remember thinking at the time, I was like, I had just released it when all of a sudden the Fed talked about lowering rates. And I was like, was I wrong? I was like, I just wish the whole video out there saying that rates weren't coming down anytime soon. And then I was like, oh my goodness, like eat crow here, because I just did this whole video about it. But in the video, I talk all about what happened in the 60s and 70s and why the Fed needs to not, and
then what happened in the 80s.
Yeah.
I mean, there were times when interest rate was 18 plus.
Yeah, I recently saw, I think it went as high as like the Fed rate was like 21%, but mortgage rates, I think, got as high as 18%. I think people mostly don't know about that. I think that's kind of like an unknown part of history. This time around, the central bank is likely to remain extremely cautious, even if that means holding rates higher for longer. And my personal opinion, is this is probably pretty unpopular, but I think as well they should. I think they do need to be cautious, because it's not worth running into what happened then, where they couldn't tame it. Like as soon as things looked like they were slowing down, the chair then lowered rates right back down again, just really fast. And I think, I don't really, and if you studied it and you saw what happened, you would know not a good thing. My gut is that they're aware of the risks and won't ease too early. Okay, it's kind of funny picturing Powell this way. Deep down, Powell is petrified of redoing Volcker again. If you don't know who that is, Volcker was the chair at that time, the federal chair, and he's the one that had to raise rates all the way up to like 21%, because he was like, we can't get this inflation under control. Stephen Eisman, Neuberger, Berman's senior portfolio manager, said, okay, so deep down, Powell is petrified of redoing Volcker again. The Fed, okay, and I think this is a really good quote. The Fed has engineered what looks to be a soft landing. Inflation's coming down. The economy is still strong. Okay, so they say. Why would you waste rate cuts now and risk a resurgence of inflation when really all you need to do is declare victory? So that's really interesting. And I think there's another article like this too, where they say the same thing. But even in prepared remarks last month, Powell referenced Volcker's earlier interest rate policy as a reason policymakers don't want to ease up too quickly now. Okay, so they've got that in their minds, the disaster that happened in the 60s, 70s, 80s. Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. And that's what we don't want. I mean, we just do not want to see it go out of control again. And I think, I remember when I saw like June of 2022 and how high it had gone, I just remember thinking this is going to take a while to get it back down and to get it stable to where it's not going to just flare right back up again. So, I mean, so they're really being cautious. And I think that's wise. Let me show you this one here. When will the Fed cut rates? Maybe not in 2024. Okay, that one, maybe not in 2024 at all. Okay, is that what we're really prepared for? And guys, by the way, in a minute, we're gonna talk about some solutions.
Well, and that's interesting being this is an election year too.
I think that's the ultimate wild card. Yeah,
they do because they got to make them look good.
Yeah, and by the way, guys, please leave some comments. Love to hear your opinion on this whole interest rate nightmare that we're going through. Love to hear comments. If you have any questions about the housing market, definitely drop them in the chat. Love to answer them. But yeah, so I think, this idea that maybe not at all, okay? A Federal Reserve official on Thursday raised the possibility the central bank may not cut interest rates at all in 2024, deflating Wall Street's expectations that several reductions could be in store later this year. So that's a huge change, from it's going to, there are going to be 6 of them, or however many. And now suddenly, maybe not at all. Maybe not at all. If we continue to see inflation moving sideways, it would make me question whether we needed to do those rate cuts at all, said Federal Reserve Bank of Minneapolis President Neil Kashari. Now, that is interesting because, if you look back on the history of interest rates, okay, they really never were down in the 5s and the 4s and the 5s until after the 2008 meltdown. I mean, they averaged in the 7%. So, I mean, he's not wrong. And look at what our home prices doing right now at 7%.
Still going up.
They're still going up. Yeah. So we see in some areas, home prices are still trending up, small amount, but maybe 7% is where we need to be.
Just
people don't like
as fast as they were, but yeah.
Yeah. It's slowed way down, but people don't like it. They'd like to see the lower rates, but I think there's something to be said of that. Let's see here now. Let's see who had said previously predicted 2 rate cuts this year, added, if we continue. Okay. And this is a quote I was talking about earlier. If we continue to see strong job growth, strong consumer spending, and strong GDP growth, then that raises the question in my mind, why would we cut rates? Maybe the dynamics we have right now are sustainable. So that really does, change the mindset of when are they going to cut rates? When are they going to cut rates to maybe this is what works. Maybe we don't need to. And again, never fear, guys. We're about to bring you some solutions to this. Okay. We're about to talk to you about 3 ways you can bring affordability in and a lower interest rate. So anyway, yeah, that is interesting. Okay. That is the end of that article. Let me see what I have now. Oh, okay. So, and I talked about bringing you a solution. Let's bring you a solution.
So what is the solution?
What is the solution? That's the question of the hour. Excuse me. Hang on while I'm the miracle worker. 3 solutions, people. 3 solutions to help you get a lower interest rate in spite of the market. Okay, here you go. You ready? Number 1. Which one should I say first?
Your favorite. I don't know.
Okay, my favorite. This one is like a hot fudge sundae with whipped cream and nuts and a cherry on top. Okay, this is my all-time favorite. It's called the forward commitment. All right, the forward commitment is gold. Okay, if you're looking in a neighborhood with 4 different builders and they're all kind of the same, you kind of are okay with either one of them, and one's offering a forward commitment. Okay, that's a no-brainer. All right, the forward commitment is gold. Okay, now bowl of ice cream. Okay, is your rate buy down.
Yeah.
Ice cream is nice. I like ice cream, but hot fudge sundae is better. But they both work to a degree, but the forward commitment works so much better. So much better.
We just haven't seen as many.
Well,
of recent, probably because the rates have been higher and stuff, and actually probably a little bit also. Inventory is up a little bit, and so that means they would have to pay for more of them, and also with the not knowing what the rates are going to do, it's hard to say. A lot of reasons.
Yeah, well, what I kind of think, they rolled them out big time last summer. Okay, the builders, there were forward commitments everywhere. Like, it was beautiful. Bought a tear to the eye. It was great. All the options of these forward commitments. I personally think now, and we're going to see in a minute, I'm going to explain to you how these work, but I personally think they didn't think they'd need them. Maybe the builders thought rates were going to come down and they wouldn't be needed. So that may be why, because it does.
Well, when you're looking at most of them were more in the summer and fall time and stuff like that. The rates went way up in August, and so that was kind of, but
but they haven't been as forthcoming. I'm going to show you in a minute here. We're going to walk through several builders, and we're going to talk about the ones that are offering it and how you can distinguish between the two. But I'm not seeing them as much as I would like, because last year it was, like I said, there was a lot. We were building out entire schedules for our buyers saying there's a rate buy down here in this community, and there's one here, and there's one here. So we were seeing a ton of them then. Not as many this year, but maybe they're about to roll them out. Okay. Because I will say one just showed up yesterday, and I'm always checking the websites, and also I get the emails, so keeping track, and we build it into a schedule so that whenever a buyer tells us, hey, they're interested in this or that, we can look it up and go, oh, okay, this one's offering a forward commitment. Anyway, third way, which I didn't mention, yet, what is assumable loans? Okay, so assumable loans are going to happen with pre-owned homes. Okay, assumable loans, a little bit harder. You've got to have a really big down payment. Okay, so if you're a first-time home buyer and you don't have the cash saved up, this is not the fit for you.
Maybe you take the equity from the sale of your current home, maybe, but also you need to be aware that the mortgage company is probably going to be really strict. You need to make sure you're really qualified, very qualified, higher credit numbers, because they would rather get rid of those loans because they're lower interest rates and get higher interest rate loans. But and I've heard some take up to 5 or 6 months to close also.
Well, and one thing I would suggest before any money changes hands on an assumable is go ahead and get pre-approved with a regular lender, right? Make sure that you're
always check your buying power first,
because that's what's different with an assumable. When you go in, you won't have a lender pre-approval letter because they don't let you do it until after you're under contract, and then they have to open up a case. Okay, so that's assumables. A great option to get a 2.5% interest rate, 3% interest rate. Okay, we've had them under contract.
Awesome deals, possibly.
Yeah, I mean, if you want a solution to today's 7% rates, assumables will do it. You got to have, a good credit profile and a big down payment. Now, you got to have cash. You got to have cash because you have to cover their equity, but that is definitely a solution. All right, but let's talk about the forward commitment, okay, and the interest rate buy down, okay. Let me see here. Let me get back to the beginning. Okay, this article is good. Rate buy downs help buyers purchase new homes. Got to have them, really to function in today's market of high interest rates and high prices. Okay. For loans guaranteed by Fannie and Freddie, which is pretty much almost all loans. This is important. Seller contributions are limited to 3% of the mortgage principal if the buyer's down payment is less than 10% and capped at 6% when down payments exceed 10%. FHA mortgages limit seller contributions to 6%. Regardless of the down payment amount. Okay. Now that is important. Okay. So kind of keep your mind wrapped around that 6%, okay, is the most they can pay. In fact, and we're going to get into this when we talk about the rate buy down, but basically with the rate buy down, the seller, and by the way, rate buy downs work with pre-owned or new construction. Nothing special there. They can work either way. Right. But basically the seller, they're limited. Right. And it's, tell me the math again. 1/4 of a point is equal to. Right.
So a buy down, you buy 1/4 of a point, it's equal to 1% of the loan.
Yeah. So with rates right now at 7%, okay, with a 6% buy down, if the seller was willing to pay 6%.
The cost is equal to 1% of the cost to buy that 1/4% is equal to 1% of the loan.
Yeah. So 1% of the loan equals 1 point equals 1/4 interest rate. Okay. So if you can get that in your mind, 1/4. Okay. 1/4. Okay. That's all the seller can help you. That's all these rate buy downs. Okay. And we're going to see them everywhere. Okay. We see them with new construction everywhere. They're all offering cash towards a rate buy down. Okay. So just think 1/4, 1/1. Okay. 1 point equals 1% of the loan, and it will lower the interest rate by 1/4. Okay. So so basically you're talking at the most, they can lower your rate 1.5%. Right. 1/4 times
Yeah.
6, 1.5 points. Okay. So if going rate is 7%, a rate buy down, okay, can get you to, what is that, Master?
5.5.
5.5%. Okay. All right. So that makes
Which
sense.
would be decent.
I mean, that is decent. That's not terrible. But that's the part that's important about understanding the buy down. Okay. Forward commitments are the secret sauce. Did I tell you? Forward commitments are the secret sauce. They're amazing. They're the most wonderful thing. Okay. A forward commitment is a block of money that builders use to originate mortgages at below market rates with some advantages over the better known rate buy downs. Yeah. Some builders are spending 6.5 to 12%, okay, of the new home sales price to help buyers purchase a home using a forward commitment combined with other incentives, okay? And this is how a forward commitment works for home builders, okay? You ready? Lower rate money. The builder's mortgage company pays points upfront to secure a block of money for originating mortgages to select homes at a below market rate. Originate, not buy down. Right. Okay, this is different. Okay, this is a hot fudge sundae versus a bowl of vanilla ice cream. Okay, for a buyer ready to close on a home, the mortgage company draws from this reduced rate money to originate the mortgage and close on the home. Higher seller contributions. The builder paid the cost of the below market rate mortgage origination before any buyers signed the purchase agreements.
So there's no seller contribution with that.
Yes. So kind of that. And that's the magic. Okay. Yeah. Are you ready? That cost does not count towards the seller contribution cap. Okay. Builders can help buyers by covering their closing costs or contributing options and upgrades in tandem with originating a mortgage with predictable and affordable monthly payments. Okay, so pardon me if I get really excited by this, but did you catch that? Okay, so they can give you a 4% interest rate and not have it go towards a seller contribution. So literally, if you need help with your closing costs, okay, if you can find a builder with a forward commitment, okay, they can give you a 4% interest rate and they can incentives. Yeah. They can still pay 6% towards your closing costs. Okay, is that not beautiful? Tear to the eye. Where's your tears? I mean, this is incredible. I love that. I see why I call it, a hot fudge sundae, because that's just amazing. Saying pay your closing costs and give you a 4% rate. Okay, that's a forward commitment. There were a ton of them last summer and fall. Okay, and I'm watching right now, hoping that they're going to roll them all out. Right. We're heading into the summer. I'm hoping that this whole setback, right? Because, probably builders bought into it that rates were going to come down. And so maybe they didn't prep in advance to do these forward commitments. And so now they're like, well, shoot, rates have gone up.
I think there was going to be enough demand.
and that could be too. Who knows? That could be too. I think it's going to be
there's some areas that still have good demand. And
yeah,
so I see where the lower inventory is because they have more demand.
Yeah. Yeah. So, and I should say this is a little bit of a two-edged sword because it's the way that builders work around high interest rates. So to the extent that maybe we want to see a massive price drop, right? If they offer the forward commitment, it cuts that off.
Right.
Okay. And that's really why we didn't see a big correction, last summer was the forward commitment cut it off.
Yeah.
Because how does 7% hurt if I can walk over here to, Centex and get 4%.
Yeah.
So really interesting things going on there. Question of the hour, which builders are doing this? Which builders? And remember the rate buy down.
Let's see.
Builders can do it. Pre-owns can also do it up to 6%.
Right.
The rate buy down up to 6% is the most you're going to get there. And that's, under only the FHA and certain things. With others, it's 3%. Okay. But yeah, forward commitment. Okay. So I want to show you this. Okay. You guys ready? All right. I'm going to go down and part of my mission here is I want you to be able to identify it on your own. Okay. Because I can tell you right now, I started researching this and it was every builder was offering money. We'll give you 20,000. We'll give you, 18,000, whatever. They all had their numbers. And they all were advertising, not all, but plenty of them were advertising interest rates. So you're probably well, how can you tell the difference? Okay. And so I want to show you these builders so that you can identify the difference. Okay. So I want to show you this. Okay. Let's see here. So DR Horton. Okay, so DR Horton's offering a special right now. Look for the fine print. Maximum contribution limits will apply. So that tells me right off,
not a forward commitment.
it's not a forward commitment. They're offering a rate buy down. Okay. And so again, not that that's bad. Like you could potentially get all the way to 5.5%, right? I mean, potentially, but they're not going to be able to pay your closing costs. So if they pay all of that down, you're on the hook for all your closing costs, which might be fine. But it's, great if you can get both. Okay. Here's Centex. Okay. Now Centex, I got to tell you, this rubbed me raw. This made me mad because they were saying that they were offering a low interest rate. And the fine print. Now I've enlarged it here, but the fine print was like this teeny tiny, and it says this:
borrow paid discount.
Yeah, rate includes 3.125% borrower paid discount rate. So they're making it like they're giving you a low rate. They're making you pay the discount points.
Money.
Yeah, so they're going to make you pay it.
Increasing your closing costs.
Yeah, adding up to your closing costs while saying this is a special. So you go up to Centex, they're like, we can give you a, 5.5% interest rate. You're like, yeah, that's awesome. And then you find out you're the one paying for it. That's an example of why you always have to check your loan estimate whenever you think you're getting a good deal. It's not enough to negotiate the price. You got to check the loan estimate, because in that situation, you might be like, oh, this is so great. I'm getting a 5.5% interest rate and your closing costs are like $30,000, and that's exactly why in this situation, Centex is basically, what would you call it? A bait and what's the expression?
Switch and bait.
Switch and bait. Yes, that's a switch and bait right there. So they're like, you know what? Give you 5.5%. You have to pay the discount rate. Well, okay, but you're really not giving me anything. You're not giving me a thing. I don't know what you're talking about. Okay, so that's Centex. Okay, DR Horton DR Horton rate buy down, Centex rate buy down,
that you pay
bait and
for,
switch that you have to pay for. Okay, Brightland. Check this out. Move in quick with rates as low as 3.99%. Okay. 6.846% APR. Okay. Did that get your attention? Now, do you see the size of the fine print there? Okay. You think you would call that fine print for a reason? It's okay.
Can't read it here.
I enlarged it on the next slide.
Wow.
Okay. So it's okay. You guys don't have to try to read it. Here we go. Brightland Homes will cover the cost of reducing the interest rate for the first 2 years. Okay. So it's a 2-1 buy down. So they're offering to pay down your rate. So over here, when they said 3.99%, you might get tricked. You might be like, ooh, 3.99%, that's got to be a forward commitment. Okay. But we didn't even talk about this whole issue of the, 2-1 buy down, which is basically like a short-term adjustable rate mortgage. It adjusts 3 times and then it's fixed for the rest of the loan. So if you see 3.99%, you're like, oh, this is great. Read the fine print. Okay. Yeah, even the really, really fine print. Brightland Homes will cover the cost of reducing the interest rate for the first 2 years. Okay, so that's what you're getting with Brightland. Okay, so far we haven't seen any forward commitments. I'm looking for my Hot Fudge Sundae. Haven't found it yet. Okay, but there we go. Here's my forward commitment. Okay, History Maker. All right, and I want you to see here the beauty that's in this slide. Okay, right here they're saying 3.99% interest rate, and then look right here. Okay, look at the bottom. Look at my red arrow. Plus up to $18,000 in closing costs. Okay, so that right there screams forward commitment. If you're a first-time home buyer,
especially starting that low to 3.99.
If you're a first-time home buyer and you need a lower interest rate and you need help with closing costs, you might consider History Maker. Okay, because that's huge. It's a fixed rate, 4%, right? Plus they'll pay your closing costs. And again, that's the forward commitment, man. I can give you a low rate and I can pay your closing costs. Okay. Now, one thing I didn't mention before that I should mention about these forward commitments is they're based on blocks of homes. Right. So they might pick out like 10,000 homes, you're like a big builder. And so you're not going to get to pick and choose a whole lot. Like they may have like 5 that are like, we'll do the 4% on these.
They could also be a national forward commitment where it covers if it's a national builder, it covers. So it could be other communities and other states that are getting these also. And so, they're not going to be around forever. And if they start selling a lot in one place, so they might, that money may go away faster or, so it just depends on.
Yeah.
Yeah, they only have so much they paid, so and if they're selling a bunch in an area, so
so they're going to
yeah.
pick which ones.
Yeah.
It's going to be inventory
Of
homes. It's
course,
not
the
going to be new
builder's going
builds.
to use that as an advantage to pressure you into buying faster, but yeah.
Yeah, it's going to be specific ones. It's not going to be new builds, right? It's going to be inventory homes. Because remember, the forward commitment comes before you ever enter the scene as the
Right.
buyer. If you're doing a rate buy down, heck, you can decide all over the place how much you want the rate paid down, how much you want to go towards closing costs, whether you want a 2-1 buy down or a fixed rate. Sky's the limit on the rate buy down in terms of how you want to structure it. That's not the case with the forward commitment. It is what it is. It's 4%.
Right.
Okay. But then you get to also ask for,
Right.
closing cost assistance. That's why I love it so much. Okay. Let me see here now. So History Maker, also Kindred Homes. This one just rolled out yesterday. I got this email and I was like, yes. Okay. So I read the fine print on this one. I don't see anything about it being a rate buy down. Also, the fact, look at this right here. If you're like, well, how could I tell if it's a forward commitment or not? Of course, you can always ask, or we can ask for you. But right here, the fact that it says 4.99% and 30-year fixed rate. So the 30-year part tells us this is not a 2-1 buy down.
Yeah.
Okay, that's not a 2-1 buy down. And the 4.99%, well, the 6% from 7, that you can get is not going to bring you down to 4.99%.
Yeah.
Okay. So that kind of right there tells me, hey, we've got a forward commitment on our hands. So, with, Kindred Homes, hey, I need help with closing costs and I need a low rate right now. History Maker, Kindred Homes. Okay. Hoping they're going to roll some more out. Big providers last year, we saw it with, D.R. Horton a lot. We saw it with Centex, definitely History Maker. We saw it with Brightland. We even saw it with some of the upper end buyers. Upper end.
Highland.
Yeah, we saw it with Highland. Yeah, we saw it with Perry.
Yeah.
Yeah. So it's not just limited to, your more affordable, like entry-level buyers. But I will say it seems like it was more.
That with them.
There were a lot more because in their mind, they're thinking, if you're buying an expensive home, you've probably already owned a home before, so you probably have a big down payment, right? So they're less likely. But the forward commitment, guys, if you don't take anything away from this, with that, just think about Hot Fudge Sunday equals forward commitment. Okay. Yeah. Let's see. All right. Couple of comments here. We have a hello.
Hello.
How are you? Hi. Welcome. How are you? Oh, okay. Next comment is talking about interest rates coming down, but when are prices coming down?
Well, don't know. It's honestly there. If you look at the trends, it's kind of always even when we didn't have the high, it's always kind of creeped up every year. As long as we have a lot more people coming in this way, the prices are going to go up. But there are neighborhoods, there are some areas where there's higher inventory and less demand, that prices may come down a little bit. There's also the time of the year with seasonality. I mean, maybe higher than it was the year before, but it's still lower than it was a different part of the time of the year. So like the late summer, fall, winter time frame.
And when I see that question, when are prices coming down? My next question for you is, where are you talking about?
Right, true.
Because in plenty of areas, prices are coming down. Whenever I say that the MLS is up by 1.3%, that's a gigantic average because there are definitely areas where the prices are down. Okay. So not all of these areas are going up. But interesting, talking about interest rates coming down. Okay. So there's a link there, Brian, between the interest rates and the prices coming down. And then there's this correlation between less buyers and more inventory, right? Because we know we've got inventory coming out. So I think it's going to be like a question of where. Okay, where are you talking about? Where are we looking? Because I guarantee you right now in the Metroplex, I can show you areas where prices have come down. And we're seeing price drops. I've seen some of like 50,000 just, rolling out, and these are pre-owns. So they're not the bait and switch that you get with the new construction. Right. So to a degree, like I'm going to answer that question with right now. I mean, I really am. And this is mid-April. Okay. We should be seeing, I think, much more activity than we usually do. It seems like we've got a lot more in prior years, it seems like we've had more, in which, okay, that makes sense because they did say that March volume was down.
Right.
So I think that what we're observing it is very accurate. That we are seeing things slow. And I think it's just a lot of I don't know, like I read with that article, people are just disillusioned. They're like, hey, you promised us rates would be down by now. What's going on? But yeah, I would say answer that question. Price
Tyler,
of price is
Texas.
coming down. Let me see here now.
Cash buyer, Tyler, Texas.
Cash buyer looking outside of Dallas in Tyler. Okay, so we don't look that much in Tyler, but I would say my thought, and Dale's going to look it up. My thought would be as far out as Tyler is, it's probably price is already down, but the master here is going to look it up. He's got his computer ready and handy. Because the closer you are to, the Dallas hub, the higher, you're going to find the prices. But when you get really on those outskirts, you're probably going to see it.
They don't have March.
Okay.
So that's, let's look at.
He's looking it up. He's looking it up. But that's a really good question. And I think, like I said, it's going to depend on location. I know our builders that are on the far out exurbs, they need to roll out some forward commitments or they're going to be in trouble. And then think about what I said about Rockwall County and how low it is. And you've got Royce City literally exploding with new construction. Like they are so oversaturated there. And then the fact that they're not seeing enough volume. We already know going in, there's some math going in here. Royce City has a lot and Rockwall County is really low.
So it does say that, so February average sales price was $485,000 in Tyler, and end of March, average sales price was $377,000. So it did come down, and
So
for but also though the number of homes have been coming down since September, October last year. So number of sales available.
So the answer to that question is they're already down 11%. And what's interesting, and I know I don't have this up on the screen, he's looking at his laptop, but they went way down in December. They bounced up in January when rates were at 6%. So I would say with you being a cash buyer, take advantage of the seasonality.
So it looks like there is a little bit more demand though. Since December, the closed sales have been going up. So
a little bit more closed sales.
Not super high, but yeah. But maybe there's some opportunity there.
Yeah.
So.
All right, you guys. Well, not any more
other questions?
So I think, thank you for your response. Yeah. Okay. Well, that was before. All right. Well, guys, I think we are going to call it a night. We haven't had dinner yet. So we're going to kind of look in that direction. Thank you for joining us. Hopefully it was helpful. Okay. Interest rates, not where we want them, but there are solutions. I don't know. If you want to talk about the solutions a little bit more, possibilities, hit us up, email us, and we'll talk more about it. We can talk. So there are solutions. You don't have to despair. But whether rates are going to come down or not is anyone's guess. All right. Well, you guys. Oh, wait. Thank you for the info.
You're welcome.
You are welcome, Rhonda. Thank you for chiming in. All right. We're going to call it a night. You guys have a wonderful evening, and we will see you next week. Same time, same place.
Same bat channel.
All right.
Good night.
Good night.